All right. Hello, everyone. Perfect. Hope you all are doing good. Just a second. All right, let me just share the screen so that you guys can feel free to um 1 second. Yes, feel free to scan the QR code for our session today. Um, yes, hopefully everyone is doing good. We are having a spring break next week. So a little bit of breathing rooms for all of us to kind of catch up on all of your competitions, your classes. Definitely if you are participating in the competitions, don't take the spring break as like an actual break because it's actually kind of like a chance for you to catch up with all the work and um yeah. Suggest you guys putting it in sometimes during spring break to try to have it done. Uh, well, before we jump right in, let's give folks a few minutes to kind of scan. But then I also want to give out the poll here. Kind of want to ask you guys a little bit about your day. Um, just getting general view on where we are. What's the vibe for today? And yeah, not something too crazy. All right. Oof. All right. A lot of people are feeling great today. All right. But it's nothing wrong if you're not, right? Because we show up here trying to make our day better. All right, perfect. All right, I'm end the poll there. I'm gonna share the result. You guys want to see? And so yeah, pretty optimistic. But then let me want to launch this as well. I want to see where you guys are standing on the case competition so far. Just so seeing if you guys do need like a little bit of help or you guys kind of need a lot more help. All right. Let's see. Perfect. So for those, definitely if you feel a little bit overwhelming, definitely reach out to me as soon as possible. I would love to help any part that you feel overwhelming. I'm available to give you guys a one-on-one kind of talk over so that you could start doing, right? But I would say first and foremost, the fact that you guys showing up, the fact that you guys are doing it, and the fact that you guys like still there is like you guys trying. That's you guys. That's a good part. That's a not a lot of people able to do that, and you lived through that already. So kudos to you guys. All right. And with that, I'm not gonna share the result for that. Um, okay, but it's ended. All right, let's jump right in. Let me see how many people. Okay. All right, perfect. All right, so let's roll in with our session today, guys. Once again, this is gonna be a finance 101 workshop. Even though it's a 101, it's gonna starting out introducing you guys to the fundamental, but then we're gonna jump into the practical part, which is how is these fundamental concepts apply into like in finance roles. Um, and here's the agenda for today. Once again, we kick it off with market updates, then jump into the fundamental, and then go into the application part, which is the valuation methods, which quite gonna be quite helpful for the case competitions, but also generally it's quite helpful if you are pursuing corporate finance, or if you pursuing even higher finance, DCF valuation, relative valuation are very relevant. All right, to kick it start with today, we are welcoming Toby Fan, Diego Roldan, and later on, Reed Jaginski will update us on a few additional resources. Um, let's jump right into the new section. All right, for today news, we are welcoming Toby to kick it start. So Toby, if you could unmute yourself, well, give a little bit of introduction about who you are, Toby, what you're studying, and where you are right now at school, and what you're pursuing, and then jump into the news. Thank you.
Thank you, Win. Hello everyone. I am Toby Fan. I am a economics major and minoring in finance and minoring in accounting. That's a lot of stuff, but that's who I am. And I am also a senior at University of Houston, and I want to pursue into an oil and gas industry or tech or even finance. And when it comes to roles, anyone into finance, I wanted to pursue in corporate finance, but I wanted to be myself as a financial analyst or data analyst as I pursue myself uh, as I keep going for my career.
Yes. Oh, and before that, maybe Diego just introduce before to the members about yourself first before Toby he charm in and talk about the
Yeah,
news.
no, for sure. Thank you, Win. So my name is Diego Roldan. I'm currently a sophomore. I'm studying finance, minoring in accounting. I guess what kind of area in finance right now is a little up in the air, but yeah, yeah, it's just a little bit about me.
Sounds good. Thank you so much, Diego. And so Reed, just so chime in and share a little bit about yourself. I forgot if you have introduced yourself last time with the members.
I probably did, but yeah, I'll go again. Anyways, yeah, I'm Reed Yasinski. And I'm a junior here, also studying in finance. Planning to look something more corporate in the oil and gas side too, like Toby. I guess a dream would be trading. Yeah,
Perfect.
that's me.
Sounds good. All right, Toby, please hit it. Give us the update on the news.
Okay, thank you, Lance. So for this week's newsletter, this week's newsletter, we'll be going through different highlights, especially with what's happening with the war with Iran and about the US the United States losing 92,000 jobs in this last month, and even with Oracle, Bitcoin, and about LNG shutdown in Qatar. So I think can you go to the next page for the war in Iran? So we've seen that for this past few weeks we've seen a lot of news relating to the war of Iran, and with that huge price with that huge supply shock, that will affect some of the production from the United States. And because of the war outside of the United States, and we've seen that crude oil has jumped prices by a lot. So I think that's going to play a huge role within the U.S. economy, mostly because that since that there is a war outside or any global intervention outside of the United States, exports were generally going to go down, especially with oil in this case. And oil is a huge essence with the U.S. economy. So, and we can see that on the bottom left on the bottom left of the screen we see all the ETF performances. So with the rise in defense and energy, most likely we're gonna see how the future holds when it comes to how the US is going to intervene, especially with just now that, according to the bullet point, that the United States have rolled out a insurance plan and plan to offer a US Navy. So with all of this happening, we're gonna have to see how the future holds on how the United States is gonna handle the war with Iran. And with furthermore, how much of an increase, how long will that increase in price of oil will get, which is something that's we're gonna need to keep an eye out on. And if we go to the next page,
One thing real quick want to add on top of Toby point is
oh
that you guys look at the price when you guys pumping the gas. I just literally last week when I paid the gas, it $30 to have my tank full. Now it's
yeah,
go up to $40. So which is like a lot. This is one third of increase. And you guys can imagine if that gonna be the price for like the next few months. it's gonna be very crazy to our market since everything relied on oil to move all of your products that you get at Walmart needs some ship to like need some trucks to move that stuff, right? Just a few
Mhm.
perspective. Yep, but thank you, Toby.
Yeah, you're welcome. And was jumping on the labor market right now, and we see that the U.S. February job report shows that pay U.S. payrolls decreased by 92,000. And and just a little summary of this page. Some of the things that contributes to the payroll decrease includes obviously layoffs because of increase in AI and automation, weakening labor markets, and also a pressure in healthcare. With pressure in healthcare, that's due to a decrease in government funding programs, which would all definitely increase rising operating costs. And based off the last point of this newsletter, with this temporary cuts on jobs, that's going to temporarily affect the unemployment rate, which, as you can see, it also unemployment rate increases to 4.4%. But it really matters. But what it does matter is how long will this with this increase in unemployment going on,
Hmm.
and with the war going on as well.
Hmm.
We've seen some speculation on how on this might lead to a concern of stagflation, high unemployment, high inflation because of the increase in oil price. So this is going to have to play out on how long will this decrease in jobs is going. And I can see and we see that now finding a job in this labor market right now is a lot very difficult, especially for those who is especially for me who's going to be outside of college or even trying to go into internships. Going for internships takes a lot more time and effort just to get for one internship. So with this ongoing trend and with the war we're going on right now, and also based off of the February job report, this might be a concern assuming if this will keep going on for several weeks or several months. And Win, do you have anything you want to add to it?
Oh, but no, you hit the point perfectly, Toby. So definitely Toby is talking about this 4.4%, which is the unemployment rate right now. If you guys continue to see this 4.4% keep going up, man, that means like we are in terrible spot. It means that unemployment is increasing, and that is us. That is us, right?
Hmm.
However, one thing to say is that the fact that you guys are sitting here and updates about the market, that is we are trying to be more competitive in this job market. Not a whole lot of students like sit and understand what is unemployment, what is oil and gas has to do with the market, right? So just a few more things want to add, but you are covering it great, Toby.
Yeah, thank you. And this is the one that I worked on last week. We have this is about Oracle. With Oracle going on for the past week, they're planning to cut thousands of jobs in order to increase their investment on AI data center buildouts, which in turn this is in relation from the last page that you guys just saw on the payrolls. This is no different. This is no different. And we see that
Mhm.
according to this, Wall Street projects expenditures to increase as 20 billion over the next few years. And based off all of this, this will lead to a decrease in Oracle stock last Friday. And with this big in AI investments with the cutting in jobs. Oh yeah, and one more thing that they have a largest restructuring plan of $1.6 billion based since for the past 13 years. And with all of this, this would lead to huge uncertainty, especially when we're gonna have this increase in expenditure projected for the next few years with the point with Oracle cutting thousands of opportunities at the same time. So with all of those factors taken into consideration, this is gonna be very uncertain if the expenditure on AI investment on data centers might not go well. So that's
Mhm.
pretty much on my take on that. Do you have anything else you want to add into?
No, you hit the point, all the important point there, Toby. Maybe additional thing I would add is restructuring costs would means well, this is how much they um yeah, well, Toby just double check this restructuring cost. Is that like to lay off people?
No, no, not real. Doesn't include laying off people.
Okay. It's like to invest in AI, is that correct?
S- Yeah, some of the
Okay.
cost is splitting to put adding in more investment.
Okay. So maybe a few things want to add is last week you guys see the news that like AI company Block they are laying off people. Before that was Amazon. So it is showing the same trend, right? It is showing the right trend that like it's showing more unemployment. So that is from these company, but then also in the health industry. Um, but yeah, you hit the point. Thank you so much, Toby. And then Diego, would love to have you join us to update on
Yeah,
that.
no, I appreciate it, Win. So, I'll be covering just kind of the stock highlights of the week. So, I guess kicking it off with Bitcoin, getting into that crypto. Yeah, Bitcoin had a crazy volatile week last week. Again, we saw some significant swings in the price. Bitcoin climbed to above $72,000, right after falling a brief dip of $63,000. This kind of has to do with some of the geopolitical stuff. Not to mention, like, I'll get into it a little bit, but what I'm about to talk about is um, different companies and the big institutional demand that we're seeing with Bitcoin right now. A company called Strategy, led by Michael Saylor, is the biggest institutional crypto holder when it comes to Bitcoin, at least. But yeah, last week we just saw 1.2 to 1.5 billion in total inflows in Bitcoin specifically. Um, Strategy, the company I'm talking about, purchased over 3,000 additional Bitcoin for roughly $204 million, which is huge, but it kind of tells us where Bitcoin stands in the market right now. But yeah, so why do we see this huge volatility in Bitcoin? So again, it's a combination of geopolitical kind of effects that have been going on in the world, obviously with everything in Iran. Everything has to do and affects the market in some way, shape, or form, and we're seeing it right now. Something else that's not talked about enough, in my opinion, is the early profit taking that we're seeing a lot of investors take right now. Since Bitcoin is a higher risk asset, a lot of people trade it in the short term. So what we see is a lot of investors buy real quick and then they sell real quick. So once levels hit like $70,000, it everybody starts to sell off. And sorry, a lot of those short term investors start to sell off. So of course, it's just accentuates the kind of price swings that we're seeing. Um, yeah, moving on to Qatar LNG a little bit and getting into that natural gas that we're seeing. This is where we saw the geopolitical stuff really, really bang in on the market and the different price changes that we're seeing. Um, so yeah, Qatar Energy has effectively halted its production in its main export facilities following drone strikes in specific industrial cities. This is like a huge critical blow to global energy security right now. Obviously, if you're getting hit by drones, you can't work, and especially something like natural gas, it's huge. But the impact of these drone strikes were instantaneous. We saw it overnight. Qatar accounts for 20% of global LNG exports, which is just natural gas, liquefied natural gas. And with the Strait of Hormuz, which is one of the primary channels that they use for transportation, there is no other alternative route to get that natural gas in and out, right? So we saw the European gas prices, like specifically in Dutch, surge by 50%, which is insane, right? And a lot of Asia benchmarks also rose by nearly 40%. Um, Asia is feeling, again, Asia specifically is feeling the blunt trauma of this, as over 80% of Qatar's contracts are with China, Japan, and India. Even India's like fertilizer industry, which uses a lot of natural gas, is down almost 80%, which is a huge risk, right? Um, Wynn talked about it a little bit, but if you've gone to pump gas recently, I mean, prices are insane. I know Wynn said that it took him like $40 to fill up. It took me almost $70 last night to fill up my tank. So it's not fun right now. But Yeah, Goldman Sachs warned us a little bit that with a month-long shutdown of this, if this continues for another month, we could see European gas prices even double. So it's gonna be crazy. Yeah. But just kind of I guess wrapping up with that, moving on to the economic calendar a little bit. What I really wanted to highlight here was really just Wednesday. Wednesday's gonna be pretty much the biggest day for macro watchers. We're getting both the headline and core inflation figures at 4:30 a.m. that day. So be on the lookout, set your alarms. But yeah, especially after seeing the crazy volatility that we've seen in energy and crypto, the everybody's kind of really curious to see how this inflation is going to move into the core goods and kind of core services that we use. Yeah, investors are looking for signs of cooling trends. So yeah, if these numbers come in higher than expected, it could signal that the Fed will keep interest rates higher for longer, which typically puts downward pressure on both tech stocks and crypto and natural gas as well. So yeah, just kind of wrapping up with that real quick. Um,
Thank you so much.
of course, yeah. Going into the FA news and kind of upcoming events, some things to be on the lookout. So today, obviously, we have our educational workshop. On Wednesday, we'll have our conscious capitalism. So learn from experienced consultants about conscious capitalism and the life of a consultant. So if you're curious about the consulting industry, definitely be out there. We'll be looking forward to seeing you there. Um, yeah, and then on Thursday, big event here, huge event. Everybody listen up. But yeah, the analyst team will be hosting our second R&T workshop. So huge thing to look forward there. It's gonna be an
Yes.
investing workshop there. We're gonna be covering options, contracts, futures, technical analysis, and everything else that you could think of. So if you want to get
I-
rich and if you want to read the
Is there
market,
a
come out.
winning prize, Diego?
There's always a winning prize.
Okay.
So definitely
Sounds
come
good.
out and try your best.
Yeah, sounds good because it's before spring break, you guys. Like just shoot a shot. Maybe you guys have some winning prize for some drinks before spring break. But thank you so much once again, Diego and
Of
Toby.
course.
Um, a few things would love to add on top of these news that for the Bitcoin, once again, guys, it is a risky asset, right? So you guys want to research in depth before if you guys considering investing or not. But you are taking it at your own risk. Um, One thing want to share with you guys that these oil and gas in news is so important. If you are talking with Chevron, Exxon, BP, right? If you're looking at right now, their stock is going up. Why is it? Right? Because their revenue is driven by these oil price. If oil price go up, you must buy oil regardless. You must buy to go to school. So they able to charge you a higher price for the same amount of oil. So that's why their evaluation stock going up. Um, yeah. But other than that, would love to invite Reed to help us. So with all these market news, it's sometimes like how do we keep up to date? Like it's the development of news, like news every single day is different. How do you capture the essential news, right? So Reed would love to have you share with our members here, which are some of the news sources or website that you use to kind of stay up to date with the market.
Yeah. So for sure. Personally, I always prefer at least having one news source that's going to get you sort of fast push notifications to your phone. I personally do both Bloomberg and Wall Street Journal, and I have MarketWatch. And if you look, we actually have some student discounts for all those if y'all are interested. I believe the MarketWatch one is actually free, but basically what they're going to do is they're going to get you like up-to-date headlines at the minute to your phone so you can keep up with all the important stuff. The other thing, the good free stuff like Yahoo Finance and especially CNBC, I believe Bloomberg also has one, but they have like running TV shows basically all day that cover like the live stock market. They have interviews, they'll do earnings after the market. It's just sort of to give you a pulse on where stuff is for the day. And to do that, you kind of have to like sit back and consume sort of the whole market. So you have tickers flashing, people giving interviews, sort of giving breakdowns and numbers, and just like if you're sort of involved in all that art environment and you're absorbing all this information, a lot of it's going to start to come and make sense to you. But most important part is just getting it like out in front of you. Another thing you can do is Spotify. Like there's some podcasts you can listen to. Me personally, one of my favorites is Professor G Markets. It's a free one, but they have paid ones. They'll sort of give you like every day, there's an update with an expert on a certain part of the market. And then lastly, the data. So there's a lot of economic data that comes up and we cover some of it. I'd say the most important is going to be, so at the beginning of the month, you're usually going to start with like business surveys, consumer confidence surveys. Then you're going to move on to employment, like the payrolls we saw. Then there's housing and inflation. And if you sort of keep up with the schedules of those, you're going to have a good pulse on like where the Fed might be in the economy before those quarterly GDP numbers come out. And that's what traders do in real life. They keep a pulse on all that. So I'd say generally try to have a good idea of like where the Fed is, the general economy, and then different sectors of the stock market. Like where's energy, defense, oil, and then maybe some commodity prices like all the precious metals, gold, silver, palladium, you name it. If you can sort of keep up with all that through any of these sources, you'll have a pretty good idea of what's happening in the market at any given point.
Thank you so
Any
much, Reed.
questions?
I do have a quick question is so the news could be like a lot and I guess you have been doing this for a long time, but do you have any suggestion for new folks started to build that habit? What were some tips to, like to digest the market like kind of like slowly? Because it could be like a lot like oil news, unemployment news. It could be a lot. How do you digest?
I'd say it's really the time spent in it. I personally started off, I would watch like CNBC every morning. I still do, just because it's free and it's a great way. They'll explain things that are happening. In terms of slow, I also like to start off like reading like a Wall Street Journal or a Bloomberg article every morning, sort of the top headline one that'll give you more in depth on what's happening. It
Mhm.
won't cover everything, but generally those articles are going to help you digest stuff slower. Now the point is like the market moves really fast. You can only slow it down so much. That's why I say like have a news feed notification that's going to come in fast, like at the second or the minute the news strikes. You just can get a pulse on it whenever it happens. Because if you don't keep up for like a day or a week, you're going to be pretty behind sometimes, especially in these times if everything's super volatile and important.
Thank you, Reed. All right, and with that, we will wrap up with the analyst. Thank you once again, Toby, Diego, and Reed for your help here. One last thing I want to add on this part is you don't have to know everything, and it is actually how in the real world people work. People have expertise. Sometimes let's say I'm an expert in real estate. So then I would just cover everything in real estate, but then I did not know everything in oil and gas. That's why we have someone expertise in oil and gas. And that's the perfect part of analyst team is that each of us have a specialty. And when we're writing these news, we kind of like learn from each other and know, oh, all right, that industry is something that I learned. All right, but other than that, let's jump into our workshop today. Uh, Definitely start out with some basic concept first. First of all, it is the concept of time value of money. It is a core knowledge when it's come to finance. So everyone knows that so basically this is the definition for it to say money today is worth more than the same amount of money in the future because it can be invested and earn return over time. So the first question it's the description and it's late today and you guys was like, all right, I couldn't digest this. What does this means? All right. So a quick question is 100 today worth more than $100 a year from now? AKA, would you rather receive 100 today or a year later? Just type in the chat, guys. If you are about to like receive 100, would you want it today or would you want it 100 year later? Just help me type in the chat so that I kind of know. All right. I'm waiting on anyone saying a year later, because if you do so, I will actually give you a year later. I'm just kidding, guys. Don't do it. All right, so everyone's saying today, right? So it's basically that is the time value of money. You know that $100, if you wait for a whole year, it's gonna be losing its value, right? There may be a risk of me never giving you that $100. So there is a concept, even though there's a concept of time value when it's come to money. So next up. So here is the answer, right? The money has the time value, because if you receive that 100 today, you could actually invest. Let's say you invest in S&P 500, and you guys know it has a return every year of average 10%. So with that 100 today, you could put and earn an interest. Secondly, there's a risk of inflation. You know that inflation keep going up, and if you don't invest and if you just keep it in your house, then your money will worth less in the future because of inflation. Inflation is bound to happen, and usually, yes, and you guys can see the inflation right now is 3%, right? So if you leave it in your house, man, inflation gonna eat your value. And lastly would be a risk and uncertainty. There's a risk of me never giving you that $100 if you wait a year later. So you want that 100 right now. And so this basically just a picture for that. I don't think we need that. All right. Here is a few terminology related to time value of money. The first one is future value. And the definition of that, and if you guys are in the finance class, now you already know this, but for those who don't, it means that what money today will grow in the future. So basically saying, if you invest $100 into, let's say, Tesla, how much would that be 10 years from now? If you're interested in asking that question, that is you interested in the future value of that Tesla stock, right? So example is that you invest 1,000 today and then earn a 10% per year. You want to see at the end of 10 years, how much would that 1,000 will be. Here is a tip. So I think it's frequently used in wealth management, because a lot of time, let's say in retirement, right? You want to see, all right, now you have to plan for retirement. So how much you should invest right now, so that when you retire, you have enough money to cover your time when you spend on the resort or somewhere. So frequently used in wealth management, the concept of future value is frequently used in there. And then here's another terminology. It's called compounding. It goes hand in hand whenever you use future value. It just means moving money toward the future. Well, just stay with me, and then it will make sense later on. All right, the next terminology is present value. So before we talk about future value, now we talk about present value. So basically, it's just saying the future money. What is future money worth today? And it is frequently used in DCF, right? And so this workshop today, the main point is we focus on the present value instead of future value. But I just want to share you the concept of that. All right, so now an example is a lemonade stand. I'm going to use this to kind of explain to you guys what is present value. Let's say you own a lemonade stand business, right? And you know that you're going to make $1,000 each year of that lemonade stand business for the next 4 years. Then you're asking a question, all right, I no longer want to do this business. I want to sell my business. Then how do you sell your business? What is the value of your company, right? What is the value of your lemonade stand? You don't know. But then that's come a concept of DCF. that help you evaluate your company. So here is the drawing of the money you're gonna make in the next 4 years, right? 1,000, 1,000, 1,000, 1,000 for next 4 years. And using the concept of present value, what it says is that bringing future money to today. So this is exactly what we do. We're bringing that $1,000 back to today. And then, so you guys see the arrow, right? That's showing you bringing the money from the future, bringing it back to today. But the question here is why is the money lower? It makes sense when it's lower because, well, stay with me for now, just saying it's lower. But because it discounting back by 5%. All right, you was like, what is discounting? Right? I'm gonna explain later on. But keep track with me is right now we're bringing these 1,000 back to present value. All right, and if you do that and you add them all up, this is how much your company costs. Your company will be valued at $3,545.95. That's how much you want to sell your company at. If you for sure that in the next 4 years, you are able to generate $1,000 for your business. Keep in mind that this 5% is called a discounting rate. So that is how you bring the 1,000 back to 952. That is because you apply this 5%, right? Another term, discounting, right here, it just basically mean moving money back in time. So every time you see present value, you're using discounting. You just say, all right, I'm discounting 1,000 back to present value. I'm discounting this back. Yeah, that's how you use the word discounting. All right, so the lemonade stand right here, we say that it's gonna generate for 4 years. But in real life, your business gonna be forever, right? Because you never know when your business is gonna stop. So in real life, actually, your 1,000 is gonna be going infinitely in the future. Then how do you value? So this part where it's starting to go infinitely, like this cash flow going infinitely in the future, what is it called? It's called a terminal value. So bear with me. Right now, just check the word. You don't need to be panicked. Just terminal value. All right, Wing said it's like whatever that gonna go forever. So that's called terminal value. All right. And now let's say you have the terminal value. Then remember these $1,000. If you bring it back, right, to present value, to present value, to present value, and then bring the terminal value, which is all the infinite money that you're gonna make in future year, and you bring that also to the present value, then once again you added them all up, added all these present value up, then that's become a valuation of a company. So this is powerful because let's say you are academy and you were like, all right, if you figured out the terminal value, which means like the infinite cash flow that academy gonna generate, and then you bring it back to present value and added them all up, you basically know how much is academy worth. And well, and let's keep it sinking. All right. So let's jump into the next portion. So far you guys kind of confused why this 5% come from, right? And so far we're talking about discounting. But then now let's digest what is this 5% means. So in every investment, you require a return, right? When you give your money to your friends, right? You want to say, hey man, just I give you $100, but tomorrow give me back like 120. You don't just give and I know you guys like just give and never take back, but well, in reality, you want to get some return back, right? So there's a return required for every investment. And this 5% right here is the return that investor wants to have, right? Let keep it at that for now. So there is no such thing as free lunch. The higher the risk, the higher return you require. So let's say you invested in Bitcoin, then you want the return to be like 100%, 1,000%. That is good enough for you to take that risk, right? And it can be different from people to people, but generally, the riskier the asset, the more return you want to get out of it. It just makes sense that way. However, this is interesting, guys, because there is such thing called a risk-free rate. By any chance, so this is open questions for everyone. By any chance, have you guys heard of the Treasury, US Treasury? Who can help us explain what is US Treasury? If anyone want to take a shot at this. All right, analysts, you guys have to unmute to help me out. What is US Treasury? I'm gonna be sad if you guys don't know.
It's the rate the US government offers people that buy their debt. And it's typically like the base rate because nobody's safer than them. So this is basically what you can get for free in terms of getting your money back.
Okay, sounds good. Thank you, Reed. So Reed is correct. I'll just I just say it in a even lower level description would be, so let's say the government, they need to, they need to build school, they need to build road, and how do they get the money? One way is because they borrow your money, right? And that is usually called US Treasury. Whenever they borrow your money, they give out US Treasury to borrow your money. And let's say the government promise that they're gonna pay you an interest of 2%. Then that is considered risk-free. Why? There's no risk at all. But you could say, what if the government never pay me back, right? But think, what if the US government don't pay you back? Then what's that said about the economy, right? So there is an agreement, like everyone in finance, everyone knows that the government, they make an assumption that the government will forever pay you back. They will pay you back regardless. So that is why it is risk-free. So just keep in mind, government, the treasury bond, it is called risk-free. Let's keep going. All right, this is gonna be a new concept, a new kind of I'm not sure if principle of finance you guys learning this yet, but you will learn later on in the semester. But it's called capital asset pricing model. Which is also called CAPM. And this is the graph, and it's looked very high level, but bear with me. I'm not understanding all this, but let me explain to you what it means. So on the y-axis, which is a vertical here, it's called expected return. And then the higher you going up, the higher return that you're gonna expect, right? The x-axis here, which is horizontal, it is risk, which if you go on to the right, the more risk. So it just means the more risk you are taking, the more return you require for it. That's why this arrow is going diagonal like that, which just means that the more risk you're taking, the more return you require. And just look at the bottom here. You guys see risk-free return, right? Right now, if you Google search this, what is the US 10-year Treasury? It's gonna show you this percent. So basically, in every investment you are doing right now, this should be the minimum you guys should ask for, right? Because the government, even the safest, the risk-free, say that 4.13%, but then your friends say, all right, but then your friends say, hey, I'm gonna give you 2%. Then that guy is kind of like tricking you and lowballing you, right? But yeah, even the government is offering you 4.13%, which they guarantee they will pay you forever. They will not, yeah, they would not default. All right, let that sink in. One more thing I wanna talk about this model is that recap before we are talking this 5%, right? So this model is partly explaining that 5%. Yes, just bear with me for now. What else should I say? I will talk more about this when in the Excels that when we start doing it. But then let's hit on to maybe one last thing I would want to say. All right, I'll say it later on. My apologies. All right, on to the next part is the new well, this is not the new concept. You guys learned this during the last workshop, which is the concept of capital structure. So you know that company when they want to want to have more financing, which means when they need more money to do whatever they like, it is coming in two ways, right? One is equity and one is in debt. Equity is, you issuing share to the public and we, the investor, buy it. Debt, right now you are doing the academy, then the debt is basically what you're doing there. You're giving the loans to company. All right. But a new stuff that you guys learning is that there's a cost to your debt, and then there also a cost to the equity. So what does it means? When it's say cost of debt, it just mean so when I say cost, it just mean what is the return that they require for that debt? What is the return that they require for that equity? So that's explained the 5% that we just talking about. That what is the return requirement, right? And so let's keep in mind that there are two portions that you have to consider, debt and equity, when you're looking at return. And here's the infamous thing called WACC, which whatever you search online on YouTube to learn about the stock pitch, you would come across this stuff called WACC. Once again, well, the term is say weighted average cost of capital, but for now, let's just say it a WACC. Basically, it just means a return, right? The return. And you remember the 5% I'm talking about, right? So that WACC is talking about that 5%. But keep in mind that there are two parts that come into this WACC, which is debt and equity, right? So all right, I'm just gonna skip this definition because I don't even know what that means. But let's skip it over. I love the more practical part. That's how we learn. Let's dive into the first method here. So we're done with the basic, but now let's go into the valuation part. I think this is more hands-on and more interesting for you guys. So the concept of DCF. DCF is standing for discounting cash flow. And at this point, you were like, what does that mean? I'm gonna help you out. So whenever you bringing money back in time, like the arrow here, that is discounting cash flow. So this is the cash flow for the next 4 year. You are discounting those 4 year cash flow back in time. So that's just what it means by DCF, discounting cash flow, bringing money from the future back to the present. So these are the steps. Let me see. These are the steps. So in the next few steps that we doing in this Excel, first we're gonna have to forecast the free cash flow, and then we're gonna count it. We're gonna calculate the WACC, like the 5%, the interest rate, and then we calculate the terminal value. And then we're gonna discount all of that back to present value, and then this is gonna be a new stuff you guys learning. That is calculate the stock price at the end. All right. All right. Here's an example. For Academy, this is what you have for your Academy income statement, right? And what we mean by cash flow is the net income. Well, not exactly, but I just pretend the net income is the cash flow. So let's say you forecasting 26, 27, 28 cash flow. If you're able to bring all these back to the present value, that is telling how much is this company worth. Let that sink in a little bit. All right, let's go into our Excels. And I did share this with you guys on the GroupMe. Also, the solution to that is on YouTube. I'm borrowing this template from a YouTuber, so don't actually pay anything for the course here. But let's jump into the first tab here that's called free cash flow, FCF. So basically, this is how you're gonna find your free cash flow. This is let's just do a practice, but basically it just means that free cash flow. Let me see, double check. All right, to calculate free cash flow, first of all, you need EBIT, which is already have it here. I'm just gonna be copying that. When it's come to, we have to subtract the tax from it. Which what we do is that we're gonna have to take the EBIT multiplied by the tax. But then because we want to subtract, I'm just gonna put the negative up there. This just follow with me, guys. If you don't understand, look at the YouTube video and you get more explanations, but just follow it with me. Once again, depreciation, you just want to put a negative. Well, let me double check. You want to add back, or you want to subtract. Well, I remember we want to add back depreciation, amortization. You want to add that back. We basically added both. For capital expenditure, you want to subtract capital expenditure. And then for non-cash expense, for this one, I'll just do that. And then you just, at the end, just do a sum of all this. Let me double check. All right. And that's how you get the free cash flow. Just follow for now. I think you guys should focus more on the WACC here. This is a harder part when you guys doing the next competitions, or just for your studying. I think this is the harder part, which is calculating the cost of equity. Well, for now, what I would do is just calculating this equation right here. Let me first reference back to here. So you guys remember, this is the CAPM model that we have. And here is the equation for it. But keep in mind with me, the RF right here, it's just standing for a risk-free rate, which in this case is the Treasury 4.138%, because the government never failed to pay you back. B here just standing for beta, and you're gonna ask what is a beta? It just means, well, for now, just keep it simple. Right now, you just take whatever beta that I given to you. ERM right here, it just means that the expected return of the market subtract, once again, the risk-free rate, which is the 4.138%. Well, not gonna make sense yet, but just follow me. I think you will learn more when you look at the videos that I sent on YouTube again and do it yourself. I think you're gonna learn a lot that way. So once again, what I'm doing is I'm gonna calculating this first for the cost of equity, right? So I'm gonna hit equal, and once again, risk-free rate, it just means the Treasury right here, because they never fail to pay you back, plus beta, right? I'm just saying right now, just copy whatever beta I'm giving you. And then you want to multiply with what? With market return, subtract the risk-free rate, which, the 2% talking about. So cost of equity is 10%. And you guys remember what I said to you guys is when we calculating the WACC, there's a equity part and there's a debt part. So cost of equity is related to the equity part. We'll share with you guys later. But when you guys calculating the WACC right here, this is the formula for it. Don't be too confused. What is this E divided by E plus D? It just means what is the percentage of equity over the whole capital structure. Basically, it just means, let's say E is the equity right here, divided by the sum of these two. Then it just means that out of that capitalization, how much is in equity. So now all right, this company had 54% is in equity. You guys have this ratio in the commercial banking part too. Once again, I'm just gonna find what is the portion of debt in terms of all the capitalization. So it makes sense because it adds up to 100%. But here comes the WACC. Remember, the WACC have to have equity and the debt, right? Here's the equation. First is say it's gonna take this percentage and then multiply by RE. RE just mean return on equity, right? And that's what we find up here, the 10%. So we do that. Let me close the bracket. All right. And then here come the next part of after the plus sign. This is 46% here. What you're gonna do is you multiply by return on debt. And where is that? It's up here. It's kind of tricky. It's a cost of debt right here. So before you have the 10% is the cost of equity, and then you have the 5% is the cost of debt. That's what I said is in the WACC, you need two return. One for debt, one for equity, right? Keep going with the equation. You're gonna multiply with 1 minus the tax rate. You're gonna ask why do that, but ask me later. Let's just go with the flow right here. Cost of debt, right? Okay, I think that's correct. Verify me if I'm wrong, but all right. So keep going. Is you're gonna find a terminal value. There's two. So let's just recap a little bit. When we talking about the terminal value, it means that you guys are finding this like infinite part, right? You're not finding this part that you figured out already. You're finding the infinite part. And in this case, what it's trying to do is it's trying to find this infinite part, right? It's not doing anything with this yet. It's trying to looking at this yellow. How much would that, if you bring all that to terminal value, what would that be? So there are two methods. The first method would be called a perpetuity growth method that I'm gonna do in this box right here. And then the second method would be called a multiple exit method, which is, well, in this case, it is given. But to kind of foreshadow you guys, because we're gonna run into the relative valuation technique. This is part of that technique. So one good thing about this is that this is usually given to you guys. So you guys usually would have these given to you, let's say 7 times right here. They usually given that info to you. So whether to use which techniques to find a terminal value, that's based on you. You could use either. Easier way would using this multiple because usually it's given to you. But let's use the perpetuity first. This is equation for it. Yeah, it looked kind of confusing, but we just have to live with it. What it say is that you're gonna take the free cash flow, the last free cash flow, and then you multiply by 1 plus the growth rate. The growth rate here is 2.5%. Usually in the real context, in the real world, it's standing for like the economy, like how much is your USA growth? Or you could even use how much is that industry usually growth by. But right now, just keep it 2.5%. You're gonna plus that. And then divide it by the WACC again. The WACC right here is given to you. So you use a WACC, subtract the growth rate again. Boom. That's how you got the terminal value. Once again, using the multiple, well, let me do it first and I'll explain to you guys. In this case, when we're using the multiple, we would take the EBITDA of that company instead of cash flow, right? Down here is cash flow, but up here is EBITDA. You're gonna multiply by the 7 times. That's how you got the terminal value. Why do you do it, right? Why do you take this EBITDA multiply by 7 to get this 994? So look with me, guys. Right here, this equation, you guys are taking enterprise values divided by EBITDA, right? So if you multiply EBITDA by that, the EBITDA cancel, which means it's giving you enterprise value. Well, let's sink in a little bit because I'm gonna explain that in the last valuation method. All right. So you could even find the average of these two if you want to be conservative in terms of your valuation. So this is the terminal value. All right. Next up is the discounting part. For the discounting part, you guys remember that let me reference back to this. You guys have to discounting all these back to the present value and then add them up. That is what we're gonna do right here. These are not in terms of a present value yet. So we have to discounting all these back to present value. Before we doing that, we have to find a discounting factor. This, if you're studying finance, yeah, you will understand. But right now, if you're not studying the principle of finance yet, just follow it, this discounting factor. You don't need it for the stock bid competition though. All right, because we learn it from by doing. Just follow it. Just say 1 plus the rate. Right here is given. But then you raise it by the period right here, which is number 1. The reason why I'm doing that is because if you drag it along, you will see that this is 2 period. And if you click here, it's a 3 period. But I make a silly mistake here because you have to fix this 8%. So that when you drag it along, you will see that this 8% is always fixed there. If you can't follow along, once again, the YouTube video is there for you to looking at it back. All right. So let's do the discounting. The discounting is basically fairly easy. You just take the free cash flow of that year and multiply by the discounting factor of that year and drag it all. So now you see these are all back into present value. So basically, if you added all this up, you get the enterprise value, right? Well, that's you guys almost done. We're almost able to evaluate company here. But once again, you guys remember, you guys are missing the terminal value, which is the 800 here. So we also have to bring the 800 back to the present value by multiply with the discounting factor. All right. So all these value here is present value. We just gonna have to sum and then drag all these together. Boom. That's how you get the enterprise value. Next up, let's do this real quick. In order for you to find the share price. So remember last step, we get the enterprise value. Last step, we get the enterprise value, which is this one right here. It's not the same because this is a different example, but let's say it's the same. Then in order for you to get the share price of that company, then you have to do this following step. Basically, what you do is there's an equation over here that say enterprise minus debt plus cash. That's how you get the equity value. Well, if you are lost, believe me, I was lost too when I look at this video. But once you do some practice, it would actually making sense. All right, so let's start with enterprise value minus the debt and plus cash. Since cash is going first right here, I'm just gonna add the cash first. Marketable security is just the same as cash, and then minus the debt. Boom. That's how you get the equity value. But then to find the share price, you have to divide the equity value divided by the share price. This is how much this company worth, $8.33 per share. So if you want to invest, you're looking at this when you want to invest for that company. Yes, we could go ahead and run everything together here. Actually, you know what? We are almost done. Let me just do it real quick so you guys kind of see if we're doing this like all along, like on one page, how would that actually look like? So all the assumption is up here. Let's start by building it. So the tax rate, you guys remember, we're going to multiply that by the tax rate. Put the negative signs before that because we want to subtract it later on. Drag it along. You guys see this silly thing right here, right? That is because I did not fix the tax rate up here. So let's say I highlight that, hit the F4 button, and then I'll drag it along. All right, at the end. So one thing to note that this guy, he helped us building like these other part for us. Usually you have to find a way to build this cash flow. That's the hard part that you're gonna have to, that you have to find later on. But for now, let's just run this through. Just find the sum of all this and then drag it out. So you guys remember, so this is the cash flow, right? And then we have to bring it back to present value. But before we do that, we have to find the WACC. And well, for the cost of equity, if you forgot what that means, I already forgot. It just means we have to find this using this equation right here. And And I forgot what is that equation. Let me just, okay, I couldn't paste it, my bad. So cost of equity, let me just do it from the top of my head. Risk-free, where's risk-free? 10-year treasury plus what? Oh my God, I forgot already. Beta multiply, all right, equal to beta multiply with risk, market return minus the let me double check risk-free rate. All right, cost of equity 12.55%. Then you guys remember these are required for the WACC. So let's do that real quick. Where's the debt? Debt is right here. Divided by debt plus equity. That for equity part, it's just the opposite. The bottom is the same for both. And then the equation for WACC. Let's just looking at it real quick. It's right here. Let me copy it right here. It just mean this portion is this multiplied by the RE is return on equity, which just mean the cost of equity, the same thing. And then we could plus, and then this the second part. And then you're going to multiply by the return on debt, which is cost of debt up here. And lastly would be multiply with 1 minus tax rate. All right, so it's come out to be 8.49. Well, and then now you have to find the terminal value. Remember when finding terminal value, there's both way. The first way is, well, EBITDA right here is a little bit tricky. You just take EBIT plus the depreciation amortization. Yep. And then that's how you get EBITDA. Let's using the multiple first, which in this case, you guys remember is usually given 7 times. So basically, like sharing with you guys, if you take the bottom and you multiply with this equation, then you get the top, which is enterprise value, EV. That's what it stands for. So we take what? EBITDA multiplied by the 7 times here. That's how you got the terminal value. But then there's a second technique. And once again, I don't remember what that is. So let's just copy it here. Basically, what it say is take the free cash flow of the last year, multiply it by 1 plus the growth rate, which is given, and then divide by everything by the WACC, which you just calculated before. Subtract once again, the growth rate, which is given. So these two are all the WACC, is all the terminal value. Once again, you could find average for those. If you say, is this practice important? Well, yes, if you want to go for the stock pitch competition, it also good if you in your interview when they ask how do you evaluate a company. Yeah, and you could explain it. Next up is the discounting. First, you have to find the discounting factor, and I don't remember what is the equation to find the discounting factor. So I'm just gonna go back to the slide here. And here it said it's equal to 1 divided by 1 plus the rate. Let me see. In this case, R right here is the WACC, right? Raised by what? By the period. Okay. By the period. But then remember, if you drag it, you will see this is wrong. The reason is because I have to fix the whack. I have to fix the whack by hitting F4. If I drag it along, yeah, that's correct. And then bring it to present value, easy, right? You guys just take the free cash flow, multiply by factor, right? And this is the present value. But remember, you also have to bring the terminal value back to the present as well. So just take that, multiply by the discounting factor again. So all these are the present value. If you sum them all up, then this is the enterprise value of this company. And the enterprise value, we're gonna re-enter it here. You guys have to run through this again to find the equity value. You guys remember, because to find the implied share value, you have to take equity value divided by the 1,000 share outstanding here. Let's do it real quick. I already forgot what equation, right? That's when you go back to this, copy it over, so that what it say is enterprise value is equal to enterprise values plus the cash, plus that, minus the debt, minus the debt. All right. And then lastly would be taking equity value divided by 1,000. That's how you get the share price. Once again, this model is entry, and you can see how much effort we would put in to do this entry part, right? But why do I say it's entry? Because usually in a real scenario, they wouldn't give you the EBIT right here easily. You have to work harder to be able to find the future money, right? To put it into perspective, you guys remember, let's say this is academy. You guys should work very hard to find this cash flow. But once you're able to find this cash flow, this exercise is super helpful and would do a phenomenal job of getting you to the finish line. And that's what we're gonna cover in after the spring break when we introduce about the stock pitch. But yeah, let's keep it at that. I will wrap it up very quickly with a new concept called, all right, I already spoiled what was going on there, is relative valuations. We have a few minutes and I'll try to cover this as quick as possible. So once again, want to share with you guys, let's say you guys trying to, so we use relative valuation when we are comparing between similar assets. And what does that mean? Let's say you are buying a house. What are you looking at when you're buying a house, right? Let's say you're trying to buying this house in Minecraft. It looks nice. And this is 5,000 square feet. How much price are you gonna buy it at, right? Usually the common way is you're gonna look at all the properties in the same area. Also, these are all 5,000 square feet. So project A is also 5,000 square feet, B also 5,000, C also. So the trick is you want to see the price per square foot. If you know these other projects, their price per square foot, then you kind of estimate how much you're gonna try to buy this company this house at, right? So that is the multiple. This is relative valuation. You try to see what is the valuation of project A. So it is $20 per square foot. The second house costs 40 per square foot, which is in a like more expensive range. And then the last would be $30 per square foot. So you know these are all like high-end houses, and they are 5,000 square feet. So you know that they are similar, right? The cheapest house is $20. The more expensive one is 40. So if you trying to buy someone sell this house for $50, you will be concerning because why? Because hey, I'm looking at the highest like property there and they only sell 40 per square feet. But now you're trying to sell it at 50 per square feet. And that doesn't make sense, right? So whenever you divide something by some value and you got to this like $20 per square feet, this blue one, it's called a multiple. It's called multiple. And it's the same with what we do in the Excel when we see this 7 times right here. So you see the enterprise value divided by EBITDA. That's giving you the multiple. So 7 times. This one you could say it's 20 times, but well, let keep it simple by 20 per square feet. But then after you get that and you find the average of these 3 blue number and divided by 3, you got it $30. Then how do you know how much you're gonna buy that? Basically, what you do is you take 5,000 and you multiply by the $30, right? That's how you value this house you're trying to buy. Well, let's keep it sinking. It's a lot to digest, but definitely next time you see relative value, you will more understand what that means. So very easy to get relative value. The data is online. If you search ChatGPT Copilot, it will yield you these multiple easily. Like you ask ChatGPT, hey, here's a list of company, give me these multiple. Give me EV divided by EBITDA for these company. Give me EV divided by revenue for these company. They're gonna generate for you, right? So these are the 3 most common multiple you're gonna see. If you could kind of confuse what should I use for my relative valuation in the stock pitch, then just use these 3 is enough to get to yeah. This is usually what you're gonna see, but bear with me. I'm gonna put it into similar version. So let's see. Let's do a quick exercise. So these are all, let's say these are all of the company that is in the same range, right? They're selling the same thing. They're basically having the same type of customer. Everything is kind of the same. Then you kind of look at these 3 valuation. These multiple, because usually when you divide something, it's just called multiple. Then you get the average, right? You sum up all these average, you got the average. All right. Quick tip, right? If every time you find the bottom value, let's say for this first one, the bottom value is revenue. Then if you have the revenue of your company, then if you multiply by this multiple, let's say 2.3 times, it's gonna give you the enterprise values. The same with EBITDA right here. If you have the EBITDA of your company and you multiply by this 6.8 times, it's gonna give you the top value, which is enterprise value. The same with this one. If you have the earning of your company and you multiply by this multiple, which is 8.5 times, you're gonna get the top value, which is the price. So that's the tip. Yes. All right. And the last one, man, after all that hard work, I think this is the most insightful and you're gonna be so happy if you get to this point in your work. That would be after creating DCF valuation, you would come up with the range right here, right? From 36.81 to 55.90 price. And also for the relative valuation, after you doing it, you will find a range for it. 31.81, 63.992. You will create this football field. And the amazing part about this is, so when you, let's backtrack a little bit. When you try to value a company, you never believe in just one method. You want to use as many methods as possible, just so you want to make sure that your number is correct. And it's when you buy a company, you don't buy it too expensive, and when you sell a company, you don't want to sell it too little. So that's why you create this football field. You can see right here would be you never would be the highest price would be 65.92990, and lowest price would be 22.68. In practice, usually come down in the table of two party when they buy and sell. You will see that both sides have analysts, right? Both company have analysts, and they gonna do analysis on their end. But when they sit together, they're gonna try to negotiate somewhere in the middle. Because let's say you would never buy at the highest price. That's just ridiculous. And you would never sell for the lowest price, right? It's just the market. You try to find the common ground, which usually, if in this case, it's gonna lie somewhere in between all the valuation technique. So that's the beauty of this valuation at the end. And let's see what else I want to cover. All right, and with that, it's a long period, but let's wrap it up. So for upcoming weeks, definitely we have the Excel workshop. That would be to build out a whole full DCF to help you with your competition. But that is just not limited for those who do competition, because we're gonna do some corporate finance functions. That is super important in interview, would be XLOOKUP, VLOOKUP. But once again, company, they want you to know how to build out a model, financial modeling, so to speak, regardless of corporate finance or any path of finance. Then after that, we will have economics and Power BI. Remember, economics, we are invited the Federal Reserves out to talk about the market. So that's going to be an interesting one. Good for our learning. A reminder for the competitions. The orientation will be the Monday after spring break. Yes, so it's gonna be the Monday after spring break. So you guys want to watch out on that one. All right, and then this is the event for this week. Remember, if you have some times, come hang out. Officers putting a lot of efforts into these. We really want to get to know you better. We are in the process of prepping for the future of FA. So if you want to take on more roles with FA, taking more leadership roles, definitely you want to show up and shake hands with these officers. It's gonna pitch that you really want to be a part of a team. And let me see. All right, and with that, that is the end of this session. Definitely good luck, you guys, on the competitions. Do let me know if you need any help. And with that, you guys are good to go. Thank you, guys. And do let me know if you guys have any questions.